Hi, my name is Jordan Wilson. Today I want to talk a little bit about portfolio reviews and in this section, how we want to compare our actual results against our initial target asset allocation. What we're going to find is that our target allocation is based entirely on our investor profile, our personal circumstances, our financial situation, our investment objectives, our constraints such as taxes, things like that. Also, a big part is going to be our risk tolerance. Are you a widow or orphan who wants to take a very conservative approach, preservation of capital, lack of losses? And that would imply limited upside, but you accept that trade-off. On the other hand, someone that might like to go to Las Vegas and play the craps tables, they will be happy with a lot more risk because there's a lot more upside. And obviously they're willing to take on more risk, which means the more potential for loss. And then there's probably us, hopefully, somewhere in between. We want to take on a prudent level of risk, but we don't want to go out to the extreme. Another aspect of your target allocation is going to be your time horizon. And your time horizon can be short term. That might be a wedding that you have to finance in 6 months, maybe a new car, maybe you want to take a trip around the world. Medium term, maybe you're saving up for a house that you want to buy in 5 years. And then long term, for most people, tends to be their retirement. Maybe it's 65, maybe it's 60, but that's sort of a long-term goal. And as we saw previously, the time horizon is going to impact what type of investments we're going to choose. Finally, we have priority. Is it a high priority? Is it imperative that we retire with enough money to live on? Versus, oh, it would be nice to have at age 50 to buy a new Porsche. Or even a medium-term objective where I'd love to buy a lake cottage, but there's a little bit of difference between buying a lake cottage and being able to retire and live comfortably on your pension. So we want to take our investor profile, factor in our risk tolerance, our time horizons, and our priorities to come up with our target asset allocation. Over time, when we do our portfolio reviews, whether it's quarterly, semi-annually, annually, we're going to find that our actual performance in the different asset classes or subclasses is going to cause a misalignment with our initial target. If stocks outperform bonds, we're going to end up with a higher allocation to stocks as opposed to the bonds, or vice versa. So over time, we should see a natural misalignment just because of the economic performance of the different asset classes. Now, the trouble is that we set up our target asset allocation based on all the factors that I just mentioned. And that's, quote unquote, the optimal mix for how we think we're going to best meet our goals. When we do the actual versus target and we're out of alignment, we have to look at it and say, should we adjust our portfolio to bring it back to our target? And that's what we're going to look at in the next segment, is how to rebalance the portfolios. But for today, we're just looking at, okay, we wanted a 70% allocation to equities, 30% to bonds. Suddenly we're at 80% to equities, 20% to bonds. Is that good? Is that bad? Should we adjust? Now, I would suggest that we want to create a target range. So when I say 70% equities, that's our target, but we want a range before we would consider adjusting. And why we do that is because in the short run, there's natural volatility. An asset might go up 5% just because of its inherent risk. And then the next year, it might fall to 5%. So if we keep adjusting our portfolios to the very precise single digit level, we end up in a situation where we're churning our accounts. And that will cost us definitely in transaction fees. If they're in a non-deferred or non-tax-free investment account, we may be triggering capital gains or capital losses. So it's nice to put in a range before we do make the adjustment. And that reduces our need to take corrective measures. It ignores the noise that could happen. And if we look at what the range should be, some of the range should be based on your individual taste. A higher risk person may say, well, I'm happy if my equities, my target's 70%, but if they're at 85%, I'm still fine, or 90%, I'm still fine. Let's ride the wave upwards. Other people, the more conservative investors, the widows and orphans, may say, you know, that's a little bit too much of a range to potentially be trapped in. Maybe I just want 75%, and 65% is my 10% range, 5% on either side. So a lot of it will have to do with your own individual tastes and your risk tolerance. I would say, though, from a purely investment perspective, that the greater the asset class or the subclass volatility, the greater the risk, the greater the range you should have, because the greater the volatility means that we're going to have more fluctuations just because of the inherent risk of that asset class. So for higher risk assets, we should be prepared to have that increased ups and downs and not be worried as much about adjusting versus a portfolio that's made up substantially of treasury bills or short-term Government of Canada bonds. So we want to look at your risk tolerance and the inherent volatility of an asset class or subclass when we set the range. And then, as I said earlier, when to rebalance, we want to look at permanent changes, permanent trends, not just the periodic noise that goes up and down. And so that's why we want to do a nice range. The other thing I would say right now is that when we do our periodic reviews, we should also be cognizant, have our circumstances changed? Has our investor profile changed? Have our goals changed? Do we have different high, low, medium, and short and long-term objectives? Because those are what drive our target asset allocation. So what you're going to find is over time, as you begin to amass capital and savings and an investment fund, then your risk tolerance may change. Your financial situation definitely has changed, and that may lead to a different target asset allocation that's warranted. So each year, you should be looking at your personal situation and your investor profile and say, okay, this is what drives my 70% equity, 30% bond portfolio split. Is that still correct? Circumstances have changed. Should I adjust my target asset allocation? And you may do so. As I was saying, we're going to jump in the next section to rebalancing techniques. And a lot of that is going to be tied into what we've discussed before, using primarily index funds, buy and hold strategies, dollar cost averaging. I'll talk a bit about if you have individual equities or individual assets, but I'll try to tie it into what we've discussed up to date. That's it for today. Thank you very much for your time. Have a good week, and we'll see you shortly with rebalancing discussions.